Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're joined by my co-host Skyler Steinke, and we are also joined by Haren Bhakta, CFA. He is the founder of Inside Ownership and creator of the Inside Ownership Index. Haren, thanks so much for joining us today.
Yeah, thank you for having me on.
Absolutely. Excited for this conversation. Haren, maybe let's start. Give us a quick background let's start with that. We'll eventually jump into your product. We'll be talking about S&P 500, and then we'll be getting in problems with like current indexes. We'll also get into your launching of the ETF, which I think will be really interesting for our viewers. But let's kick it off with your background. Start.
Sure. Well, I started out in investment management, wealth management in 2010. Started off at Merrill Lynch for about 2 years, transferred over to Morgan Stanley for 5.5 years, built a book of business. In 2017, I left to start my own RIA and microcap fund. And I actually ran a proxy contest on a tiny microcap, got on the board. Eventually, we acquired it, sold it in 2023. In 2024 is when I came up with the Inside Ownership Index, and we launched the ETF about a month and a half ago.
Okay. Tell us about the microcap fund that you were running.
Yeah, so I found a tiny little microcap out of Vegas. What it did was, it shouldn't have been public. It was a $6 million market cap. I mean, this is like a nano cap, and it sold show tickets on the Strip of Las Vegas out of these like 10 retail booths where everybody's walking the strip, right? So it's like high traffic areas.
Mm-hmm.
And I figured, that people are always going to be walking the Strip of Las Vegas, and the company didn't sell show tickets online. And this was 2017 when I kind of got involved. 2019 I got on the board, but by 2017, if you're not selling show tickets online, like you're doing something wrong, right?
Right.
So I thought, okay, well, I could join the board and inflict these changes. And it was a really difficult thing to do, to inflict change and fight a company where they are fighting with corporate dollars, and I'm trying to get on the board with my own money. And eventually I did get on the board, and we ended up buying the company. So it was this terrible timing. 2019, I get on the board. In 2020, the entire show business in Las Vegas shuts down for COVID.
Mm-hmm.
But it worked out okay because we were able to buy the company out of bankruptcy. So we ended up with the whole thing. And then we ended up selling in 2023.
That's awesome.
So it was, yeah. So
very
I don't
cool.
recommend proxy contests, it's
How'd you
it's a
find this
very
company?
stressful thing. I used to look around at microcaps all the time. So I would read Microcap Club and Value Investors Club and all these different microcap forums, and just look for cheap microcap stocks where I thought either the business was good, or we could go in and make changes and create shareholder value that way.
Mm-hmm.
But it's a lot harder than it sounds to go in and inflict change on a company when incumbents are fighting with corporate dollars, and you have to put money out of your pocket to fight them. So
Right.
yeah.
Very cool.
Yeah, very cool
Awesome.
aside. Yeah, just wanted to pick that thread. I thought that was cool. Okay, then tell us about your aha moment. So you were at the Berkshire Hathaway meeting, shareholders meeting, and that's kind of when you came up with this idea for inside ownership. Tell us about that moment.
Sure. Well, I was in wealth management, and I really got attached to Warren Buffett and his philosophy of investing. And so I've listened to every Berkshire meeting since 1994, and I've started attending his meetings since 2017. And in 2024 was the first meeting without Charlie Munger. So I bought Berkshire because of that belief and trust in Warren Buffett and Charlie Munger. And in 2024, it was the first one with Charlie Munger wasn't there because he passed away. And in the back of my mind, I'm kind of thinking, what am I going to do with Berkshire shares when Warren Buffett passes. I don't feel the same way about the company. And about halfway through the meeting, it kind of hit me that the S&P 500 will actually be buying more Berkshire Hathaway when Warren Buffett dies, because S&P is what's called free float adjusted. So when they count the size of Berkshire, they exclude his shares. And when he dies, those shares will become free floating. And with the same respect, like who would want more Berkshire without Warren Buffett? And um, who would want more Tesla without Elon Musk, or Meta without Mark Zuckerberg? These guys are the guys who created the value of their companies. Why would anyone want more without them? And we should want more with them, and less so without them, right? Because people are power law. I think Sam Hinkie said that, where people are power law. Um, and, you know, the few exceptional leaders create enormous value, and we should want more of those companies while they are there, and less so when they're gone. So I came home from Omaha and looked for all this ownership data to see, what if we could allocate to the S&P 500 stocks, but instead of using market cap, we use their ownership and proportionally invest in those stocks that way. And nobody had the ownership data. I went to Bloomberg, Cap IQ, FactSet. Nobody had it, so I had to manually go through 20,000 different proxy filings for S&P 500 constituents going back 20 years. And I'm currently the only one with the data. So I launched the index in 2024, and I think I'm probably still the only one who's aggregated all this ownership data going back 20 years for all the stocks in the S&P 500
Yeah.
as they existed at that time. So the S&P 500 changes, but I capture the ownership data as it existed in 2004, 2005, all the way up.
Yeah, so let's double click on this S&P, free float weighting. So this strips out controlling shareholders. Is that correct? So if
That's right. So I captured
mhm.
only insider ownership, but the free float adjustment excludes insider held shares and outside owners who have controlling interest. So, for example, Coca-Cola could buy 10% of Celsius, right? So the S&P will free float adjust out that 10%. But I don't count it, because unless they're insider, and we're looking for individuals that have control. Like I mentioned, people are power law.
Mhm.
We're not looking for entities that own um, stocks in other entities. What we're looking for, or a government, like acquiring a stake in Intel or something. We're looking for um, leaders that own meaningful stakes in the companies they run.
Yeah. And maybe just to touch on that power law thesis, Aaron, for the audience, can you explain that thought process?
Yeah, well, for example, venture capital. Venture capital is very power law driven, right? Where these VC funds will invest in maybe 100 different companies, but one or two will make up all the returns for that VC fund, and the rest will probably just lose money. And stocks are similar. The most stocks are not going to just lose money, but they're going to probably underperform. Where a handful of stocks will carry the returns of the entire market. There was a guy out of University of Arizona State, professor, who did a study of all US stocks over the course of 100 years. What he discovered was 4% of all US stocks over that whole century delivered all the wealth creation, and the other 96% matched US treasuries. So that is power law, where a few exceptional companies carry the results. And we see that magnified more so now with the Mag 7 really carrying the S&P 500, over the last like decade, pretty much. Um, so this is why it's really hard to pick stocks, because you have 4% really the ones are driving all the returns, while the other 96 kind of match treasury bills.
Yeah. That's a really
Yeah,
interesting statistic actually. With
yeah.
So
Well, I'll add one thing though. Academia kind of got it half right. So yes, stocks are power law, but the leaders within the organization are even bigger power law. So if you could weight stocks based on the leaders, you can exhibit bigger power law function and get higher returns.
Yeah, that's really interesting. That framework there.
what separates a founder who creates, long lasting value from one that sells early and moves on?
Well, what I find is most of these founders, at least by the time they're reaching the S&P 500 stage, they're not selling in and out of the market. All they're doing is they own so much of the company and they're slowly taking liquidity. So like Jeff Bezos has been selling Amazon for 20 years, but not like because he's bearish. And Jensen's been selling Nvidia for 20 years. And again, they're not selling because they're bearish. They, all their capital, all their net worth is tied up into this company and they slowly take liquidity. So by the time they reach the S&P stage, uh, you know, they've been holding for a long time. So in the VC space now, I think most companies at that stage, post founder, it doesn't survive, right? Because it takes that one individual to really, uh, influence their employees and the market, and they're able to drive value. It takes that one individual, and it's really hard to do. You can't innovate through committee. Essentially, you just can't. You need that one sole wolf that makes decisions at the top, and you can't just get like 10 people in a room and uh, you know come to some kind of consensus on where the market's going and innovate that way. It doesn't work that way.
Yeah, I think we need to lead up to that one.
No
With
problem.
uh, running on the thread of founders, you gave us some good examples. We've obviously talked about Elon Musk. In our pre-call the other day, you also mentioned examples like IBM. Uh, so it's really all about, like you said, these founders that are leading these companies. So give us some of those examples of historic companies that have done really well, like you talked to us about recently.
Yeah. So what I like to say is remove who made it great, and you removed what made it great. So I'll give IBM as an example. Now, a lot of people don't know this about IBM, but IBM was founded in 1911 by Thomas Watson Sr. Um, but it was his son, Thomas Watson Jr., that actually took IBM public in the 50s. And he ran the company all the way up as CEO until 1971, and remained as chairman until 1984. And IBM in 1984 was the most dominant company to ever exist, even to this day. And when I say dominance, I mean by relative size. So IBM was 2.5 times larger than the next largest company in the world. This is dominance, right? This would be like Nvidia being a $12 trillion company today. Extremely dominant by relative size. And 1984, Thomas Watson Jr., the guy who took that company to that level, uh, retires completely. And fast forward 8 years, in 1992, IBM is not even in the top 10. We're talking about the most dominant company ever, 2.5 times larger than the next largest company in the entire world. Not even in the top 10 8 years later. And today, IBM is not even in the top 25, and maybe not even top 50. So this is what happens. You remove who made the company great, and you removed what made it great, because people are power law.
Yeah, exactly. So when you take away those founders that are making these great decisions, a lot of times you just get,
Yeah,
I don't know, boards or managers kind of making these
exactly. Because you
decisions.
can't innovate through committee. And, it doesn't have to be a founder. So I like to clarify that.
Hmm.
It has to be an owner,
Hmm.
you know, because when you don't have owners, then you get committees. And when you get committees, you get bureaucracy, and you just can't innovate that way. It does have to be a single person, or maybe two or three. But when it gets to be a large committee, like most boards are, it just, you know, uh, you can't innovate. And Mark Zuckerberg even says that, his board um, is there because he goes to them when he wants advice from them. They're not there to, you know,
Steer the ship.
give him approval. You know
Yeah,
what I mean? And same with Warren Buffett. He when he makes an acquisition, the board is automatically approves it. He goes to them for advice if he needs it, but he's not going to them for approval. I mean, the best CEOs, the best innovators are not going to their boards for permission or some kind of committee vote.
that's right. Yeah, which is unlike corporate America. To your point, usually there's an approval process. The board has to make a decision versus what you're talking about, ownership, I believe, which is on your shirt today. Skin in the game. You need
Skin in the game,
right?
exactly. Yeah. Yeah, that's
Absolutely.
the whole philosophy. So I read Skin in the Game 7 times by Nassim Taleb, my favorite book. I have actually a book review on YouTube I'll be publishing this week. I'll send that over to you guys.
Nice. I love that. That's great.
Very
Yeah.
cool. You've also talked to us about some other issues, the S&P 500, as an example between, BlackRock, State Street, Vanguard. They collectively own, I think, about 25%, give or take, of like corporate America.
That's right. So I see that
Asset
as a huge systemic problem, systemic problem, because corporate America is now being controlled by passive shareholders who don't vote. And in the past, if you had I think Warren Buffett talked a lot about this, a mediocre manager destroys the most value in a organization because a mediocre manager doesn't get kicked out, right? They get put in place for a long time and kind of just destroy value. But he said this in 1997 about mediocre management. Today, now you can have terrible management and there's no mechanism to remove them because boards are now who could own no shares on their own, but automatically get money every day or every week from S&P 500 index funds, right? So, and they don't vote. So, like, there's no longer any mechanism. They kind of like by default vote for incumbents. So you have State Street, Vanguard, and BlackRock kind of just automatically voting for whoever's on the board already. And if they don't own any shares, then they're kind of just like a negative feedback loop where uh, they could do terrible things and shareholders, actual beneficial owners of the company, have no recourse into putting in maybe a new management that they actually believe in. And you actually see this taking place today with eBay. I wouldn't call eBay's
I've heard this
board
story.
terrible,
Yeah.
but I would call them mediocre, and they don't own any shares on their own. All the shares have pretty much been awarded shares, right? So you have a board who doesn't own any shares on their own, and you have a guy like Ryan Cohen at GameStop willing to put $500 million of his own money in the deal, and he's turned around. He created a significant value with Chewy competing against Amazon, sold it for $3 billion. He turned around GameStop, which was a dying business. We're talking about like a retail business selling video game cartridges, right? He turned that around, and he wants to take eBay. And frankly, if I was an eBay shareholder, which I'm not, I would be excited to have Ryan Cohen on as CEO, who's wants to only get paid if he creates significant value, and he's willing to put $500 million of his own money into the deal. I would be extremely excited because, like I mentioned, people are power law, and the right ones change everything, right? So maybe eBay under Ryan Cohen could be $1 trillion company, or maybe not. But I think we're pretty much guaranteed with the incumbents that it's not going to be the next $1 trillion company. They may, move along and match treasury bills or something, but they're not going to be that huge outlier. But under Ryan Cohen, you have that opportunity. But the board is blocking shareholders from actually making that decision. So they don't own any shares of their own. but shareholders should be able to decide whether they want a Ryan Cohen as CEO, right?
I think you're making a really important point, because the board is over here to your point, collecting, I don't know, probably $200,000-$300,000 checks every year.
Exactly.
Their
And that's what
motivation
they're
is
protecting.
their
Yeah,
motivation is keep that $200,000 check coming. As soon as Andy Cohen gets
Yeah.
into the
exactly.
picture, Ryan Cohen gets in the picture, it is they
Exactly.
could be out of the picture, and he could bring great value to the actual shareholders, but
Exactly. So, in the past, 20 years ago, I think Ryan Cohen would probably be either on the board or he might even be CEO by now because shareholders had a voice. Today, with the rise of index funds, it's almost impossible. Oh, and if it's not impossible now, as S&P takes market share or index funds take market share, uh, it's going to pretty soon be impossible when, you know, um, index funds may control more than any other shareholder combined. Right now, they're already the largest shareholder, but they are going to become so large that they're larger than any other shareholders combined, and that's a scary thought. Where, um, you know, companies are run more and more by people who have no skin in the game.
yeah, it's a really good point. So let's dive into the inside ownership index. So just take us from the top. How is it different from market cap weighted index? And maybe just give us the high level on it, and we can dive into some details.
Yeah, absolutely. So S&P, like I mentioned, you're on the opposite side of the table as these controlling shareholders or super value creating CEOs, right? We're on the same side of the table because we're using the dollar value of their ownership to index to. So we're proportionally invested to that ownership. So in a sense, you have market cap weighting, which takes all the shares outstanding, or as the S&P's case, it takes the free float adjusted shares outstanding. We make the same calculation, but we use only the shares held by insiders. So a small subset of the shares, the total shares outstanding, as the mechanism or variable to proportionally weight the portfolio.
Mm. And with when you say insiders, who exactly qualifies as an insider?
Yeah, so what we use is a DEF 14A filing that each company makes. Now, it's usually the C-suite and board, and it could range between 15 to 20 something, 21 people around there. But to be honest, the number of people is immaterial because the ownership in a healthy organization is typically uh, again, power law driven, where one to max three people own all the shares, and you could add one person or remove one person from the board, and it doesn't matter. You remove Elon Musk from Tesla, and all the ownership's gone. You could add like 10 other people, and it's not going to make a difference, right? Same with Berkshire Hathaway or um, Amazon or Meta and most any other company. Even Apple today, Tim Cook and Art Levinson actually own about $1 billion each of Apple. The chairman of the board, Art Levinson. You could add a new director or add 10 new directors, and they're not going to have $1 billion of Apple.
Got it. And then let's talk about the dollar value. So why'd you decide to go with dollar value as opposed to percent?
Well, it kind of works the same way. You could take um, 5% of Amazon uh, as a market cap, or you could take uh, basically what we're looking for skin in the game. The more what we're looking for is where leaders are going to bed thinking about their companies, waking up thinking about their companies because they have their entire net worth in that company. So that's usually a dollar value function, and we want to be somewhat close to market cap. We're not looking to um, there is no additional benefit where CEOs could own, um, you know, more than 5% or, call it 60, 70%. It doesn't matter. What we're looking for, there's no additional benefit. Basically, the correlation of returns is that once they own a certain dollar figure, there's no additional benefit to them owning more.
Mm-hmm. Is there is there potential risk of the index becoming too concentrated? And what I mean
And that
is,
too, and that too, yeah. So
yeah,
for example, Larry Ellison owns 40% of Oracle. Michael Dell owns 40% of Dell. We're not looking for a two-stock portfolio, right? Or Tesla with Elon Musk, he owns around 20%. If he owned only 10% of Tesla, I think he would be functioning the same way. So what we're looking for is that they own a massive stake in the company, but the actual percentage that they own is not as important. It's that they own a big piece of it. So and that number is around 5%. So I looked at what's called a 100 bagger. Okay, I looked at every 100 bagger between the years 2000 to
I love
25.
the concept of a 100 bagger. Maybe give the audience a quick on that.
Yeah, so 100 bagger is a stock that went up 100 times your money. You put in $10,000 and it turned into over $1 million. And when I looked through that 25-year range, I found around 21 different companies that achieved that return. And I looked at what industries they were in, what types of business, who the CEOs were. I've only found one commonality. So I found 21 different names. And you have Amazon, Tractor Supply, O'Reilly's, Netflix, Nvidia, obviously. So just 21 different companies, and 19 of the 21 had ownership of at least 5% by the insiders. So two exceptions: Apple and FICO Isaac. So Apple, surprisingly, Steve Jobs, he was there when it started, but he didn't own a huge amount. He had been kicked out of Apple, and I guess he had sold his shares when he was kicked out. And
Right.
when he got back, he didn't own that huge amount that a normal founder would have owned. So Apple was the one exception where, one of the two exceptions where there wasn't that huge ownership
Almost an
component.
asterisk there, but yeah.
Yeah. But to achieve these outlier returns, you need ownership. And the funny thing is, like, they were not all founder led. O'Reilly's, for example, Tractor Supply, they were not run by a founder. But at the board level, there was significant ownership. And the reason for that is to get these huge outlier returns, as Jeff Bezos says, if you want to be great, you have to be willing to be misunderstood. And when you have no skin in the game, you don't have the luxury of being misunderstood. So to have these huge outlier returns, you have to have ownership, because you have to be able to be misunderstood in the beginning. Amazon was misunderstood for 20 years, right? They didn't show a profit for a very long time, and Wall Street didn't understand it. And had he been a CEO, a hired CEO trying to run that strategy, it wouldn't have worked. Nobody would have allowed him to do that. No committee would have allowed him to do that.
Yeah. That's a really important point. A lot of these, innovators or unicorns of innovation are often hard to deal with, right?
Yeah. Imagine
You know?
Elon Musk. I mean, no committee would have put up with Elon Musk.
Right.
Right. So he's able to create all this significant value because he has the ownership there, right? He wouldn't. I don't think no one would hire Elon Musk.
Yeah, absolutely.
Yeah.
With we've also discussed in our previous call, we've talked about your concept of electrons versus atoms framework and how the market dynamics have really changed over time, particularly when it comes to monopolies.
Absolutely.
Give us your thoughts about monopolies in today's market versus historic monopolies.
Yeah, I think Peter Thiel said this. So monopolies in the past were built on atoms, and when I say atoms, I mean like physical structures or economies of scale, manufacturing. Right?
Right.
These were all built
Steel,
on
oil.
physical, exactly, steel. physical goods. And today's monopolies are built on electrons. They're digital, and network effects, um, innovation cycles or feedback loops, economies of learning versus economies of scale. Like NVIDIA is a perfect example of that, right? Or even SpaceX and with Tesla. And so basically, today's monopolies are electrons, and they're infinitely scalable because they're digital. In the past, monopolies were built on atoms, and they had physical constraints. So you're going to get, and it's already been started for the last like 10 years. We see it happening where, um, for one, there's no limit to the size a monopoly can get, right? So we're going to get more winner take all dynamics, or winner take most. And in the past, where monopolies would eventually get too large and bureaucratic and fall under its own weight, today, these monopolies don't have to get um, uh, large in a sense of uh, capex. Although they're spending enormous monies on capex now, but their moats are built on digital frameworks, which are infinitely scalable. So what we're going to see is um, a smaller group of companies being exceptional earners and take market share from everyone else, and we're going to see a small subset, or I'm sorry, a large subset of people as solopreneurs. So we're going to get a barbell. We're going to get a few dominant companies and a whole bunch of like uh, individual entrepreneurs who have AI as their employees and stuff, right? So we're going to give a lot of entrepreneurs on their own, and these small number of huge companies. We're not going to have 1,000 great companies anymore. And
Yeah.
the people who talk about like equal weighting the S&P, we're not going to have 500 great companies anymore. And we see that playing out. Like a lot of people talk about 100 years ago, equal weighting kept up with S&P 500 market cap weighted, but it's been the last 20 years it hasn't kept up at all, and that's just going to continue. Um, Anyone who talks about small cap indexing also doesn't understand, because uh, you're not going to have like 1,000 small cap companies do well, because what we're going to see is more winner take all dynamics. And the fact is, small caps also have access to better capital than in the past. So in the
Mhm.
past, if small cap wanted capital, they would go public. Today, the best small caps have access to venture capital and PE. So you're getting the worst of the small businesses when you invest in a small cap index. And some people who use 100 years of data um, kind of miss the
You're
point
making a really
of,
good point here. Yeah. So
yeah.
it's so how does this play into the ownership index fund? And I guess from your perspective is kind of the age of diversification over.
Yeah, well, you kind of mentioned concentration. So, how it plays out in the inside ownership index is that we are more concentrated. We're more concentrated in these leaders, and we move out of them once the leaders are gone, right? So, um, like I mentioned, leaders are power law. So, what we want is more exposure to these leaders while they're there, and move on to other power law leaders when the ones we're in are gone. So. Um, we're more concentrated. And like I mentioned, we went back 20 years when we launched this index with it's called a back test, but I don't like to call it a back test because it's not really some like algorithm. It's simply just allocating to leaders ownership, right? A very simple calculation. But what we found is, while we're more concentrated and more volatile, we move up and down more than the S&P. But I'll note that in 2008 and 2020, the two global catastrophic events we've seen in the last 20 years, the S&P 500 went down more than the high ownership companies would have, or did. I'm sorry. So what we see is that the high ownership companies are more resilient to major downturns. And it makes sense because they have better balance sheets, they're run better, they're more innovative. Uh, they also have access to capital. When nobody has access to capital, these high ownership companies or leaders like a Mark Zuckerberg or Elon Musk, Warren Buffett, they have access to capital when nobody else does. And we see that play out in 2008, where liquidity freezes up, and companies are um, you know don't have that capital or access to capital, and we get these leaders who could send a text message, like Elon Musk could send a text message to Larry Ellison and get $1 billion, right? We saw that play out with Twitter, or X now.
Right.
So
Yeah.
it's like, when the real world is really going wrong, who are you going to trust? It's these leaders who own significant stakes in their companies to make the right decisions, because they feel the pain the most.
Yeah, definitely. Yeah, I want to go back to a couple things you said I thought were interesting. One, just obviously the electrons versus atoms thought process, but the new paradigm of what we're talking about here, you mentioned with AI and just with new companies, they talk about, $1 billion company will be with less than 3 people. It's coming, right? Or
Yes.
less.
Yeah. Well,
It's
I
gonna
think
happen.
we've already seen the first $1 billion company with, I think, one person. I could be wrong.
Yeah, I think it was one. Yeah. So
Yeah.
with that,
but we're going to see many more of those. We're going to see
Right.
many more. So we're going to get a huge barbell. We're going to get a whole bunch of small companies. Employees are going to be less so as well. Like, you could just log on every day and have these like bids from people who need work, and you have your own little personal rating, and you're not going to like work for a corporation as much. So, like, for example, you have these like freelance websites like Upwork and Fiverr and things like that, but we're going to get more along those lines, where someone needs some work done and you go do it for them. And we're going to get a small number of huge companies, because they're infinitely scalable and winner take all.
Yeah, I guess with that,
Yeah.
that infinite scale mechanism, I mean, we talk about how you determine the value for companies and what it was, now what it is now. How does that change? Do you think of the value methodology, or how do you determine value? We have different ways, and network effect, obviously is different than what we traditionally value a company as, when it's more digital and scalable infinitely. How do you think about that as an investor going into these types of companies now, to make an investment and determine that value
Yeah.
framework?
Well, the best example I have of this is in July of 2020, NVIDIA and Intel were exactly the same company. They were both $250 billion companies and chip designers, right? They were equal weighting in the S&P, both 1%, because they were exactly the same size. Now, at that moment in July of 2020, Intel had 7 times the revenue, 7 times the profits of NVIDIA. It had a higher return on equity, a higher free cash flow yield. Now, to the value investor, Intel looked like the clear choice, right? Fast forward 6 years, Intel has underperformed the market. NVIDIA is up 2,000%. So my advice is, people have spent too much time focused on last year's earnings and not enough on leadership, what they own and what they're capable of. And ownership is not the panacea, obviously, but what investors should be looking at is what leadership is capable of, and using last year's earnings is becoming more and more unimportant. Not because it's not important, but what we're looking for is, how much does last year's or the past reflect what the company's capable of 5 years from now? Because stock prices reflect the future, right? Uh, 5 years from now, how much can you figure out what that looks like based on the past? And with the world changing the way it is, uh, you know, looking at the past 5 years of revenue and earnings mean less now than ever before. Now, if you're selling bubblegum or Snickers bar or Coca-Cola, yes, you can look to the past and decide what it's going to look like 5 years from now. But with the world changing the way it is now, and AI and the speed of change, last year's earnings doesn't mean as much. So you can't look to a PE ratio and say, oh, this is a cheap stock, because you don't know if it's a cheap stock, because you don't know what the company is going to look like 5 years from now. Now, a PE is only relevant if you know what the company is going to look like 5 years from now. And, you know, you're going to find that some of these low PE stocks are probably going to go to zero because they don't have moats, and AI is just going to take away their business.
Yeah. Yeah. It's interesting to think about. With Haren, one other topic that we're really interested in discussing with you is launching the ETF. So, maybe just take us from the start. You had this idea. You had done SMAs, separately managed accounts. For those that are listening, but talk to us about the process of creating this ETF from the start.
Yeah, so I created the index, right? I was looking around to find a partner. So I've talked to 50 different ETF issuers and looking to find a partner. So I was running SMAs on the Schwab platform, and I came across Corgi Funds, and they're a great partner because they have the same ethos in investing in founders and ownership, and they became my first pick as a partner because the speed at which they move at. They broke the record in ETF launches twice. So they have more than 100 ETFs, and they filed to launch another 200 more. So they're gonna have 300 ETFs this year, and that's they're gonna have more ETFs than BlackRock. And this is a new company who's leveraging AI, and their primary business is insurance. And insurance is another area where has largely been run by humans, where the technology today exists to replace humans, and most insurance companies are slow. So all insurance is a natural language contract, right? And now today the technology exists where they're leveraging AI fully to replace the humans involved, and they could write insurance and price insurance much faster than any organization because they're fully using AI versus incumbents who are very slow to incorporate AI.
Okay.
And then the same thing with launching of ETFs, right? It's very expensive to launch an ETF. It's like $200,000 a year in fixed cost. So if you're looking to launch an ETF, you kind of have to do the reverse engineering. Okay, well, how much assets do you think I could get? What fee am I going to charge? And reverse engineer like what your break even is at $200,000 a year. They are leveraging AI and getting rid of all those middlemen, you know, in the AI space. I'm sorry, in the ETF space. I'm not even sure where all that money goes, to be honest with you. I don't think most people do. I mean, it's like lawyers and trustees and all these like intermediaries that you really don't need. So they brought down their costs by probably 60 or 70% in launching ETF, and they're giving those savings back to the end investor. So, for example, they have like buffer ETFs, levered ETFs, where most levered ETFs charge more than 1% in fee, and they're charging half of that. And same with the buffered ETFs, they've brought down the fees significantly. So,
Huge advantage, by the way. I just want to mention that's a huge advantage based on
huge advantage.
Yeah.
And that reminds me of an investor called Nick Sleep, which I don't know if you heard of, but he recognized Amazon, I think in 2005, and in Costco, and he invested almost his entire portfolio in those two stocks. And he wrote about a moat called economies of scale shared. Now, everyone's heard of economies of scale, but what he figured out was when you share that economies of scale with your customer, you create this enormous feedback loop because you get more customers because they're saving money, and then the scale the feedback loop just keeps going in a circle where you just keep getting more customers, more savings, more customers, more savings, and you end up with this huge business like Amazon and Costco today. And Geico Insurance was another example where um, they would give those savings, lower prices of insurance back to the customer and continually take market share from everyone else. So
Yeah.
Corgi funds will probably be taking enormous market share by continually lowering prices and giving those savings back to the end investor.
Okay. So, Corgi aside, so the process itself. What did other?
Oh, so I found a partner in them. So I'm actually the index licensor. So essentially, I could have launched the ETF on my own, or I could partner with a firm already launching an ETF and um, kind of split the revenue. So
Right.
essentially, we're splitting the revenue by me being the index licensor and they being the actual ETF issuer.
Okay. Very
Right.
cool.
Yeah. So you're the licensor, or signals provider to the sponsor for that
Exactly.
strategy, right? And they run
Exactly.
run the actual strategy. Yeah.
You're not
Exactly.
paying
Yeah.
300,000 a year. You're essentially licensing this to them, and then you get a portion of whatever
Yes.
returns.
Yes.
Yeah.
However,
Yeah.
there's one caveat to that. They have 100 different ETFs and pretty soon 300. I'm focused on the marketing, so I am investing my capital in marketing, but at least I don't have to spend capital in keeping the ETF open or
Yeah.
compliance and all that stuff.
What?
I could focus on marketing.
So when the day you went to them till the day of launch, what did that time frame look like? And when you talk to you talk to other providers, right? I assume
Like I mentioned, they're so
Yeah.
fast. I contacted them on a Wednesday. I'm not even joking. By Friday, we had a handshake of a deal.
Yeah.
We're talking about 2 days, and all these other ETF issuers. We had meetings after meetings. PowerPoint presentations that leads to more PowerPoint presentations. Um, but these guys are incredibly fast.
What did the
And
other
like I
companies
mentioned,
tell you about how long it would take?
yeah, they love the idea. I had one issuer tell me, they want to do it,
Yeah.
and it's just that they were so slow.
Yeah. The
And
traditional process is 4 to 6 months, right? Usually 6 months for traditional ETF issuers, right?
well, that part, there's nothing we could do because the
Yeah.
SEC, when you
Right.
launch an ETF, you're on the. What I mean is from the time that they want to do the deal to the time that we get through contract negotiations and um, figure out what the economics looks like, um, coming to some kind of deal, and or getting a meeting on the calendar. It's another thing. Like you could contact them, and you get a meeting on the calendar like 2 weeks out. Like I mentioned, I contacted them on a Wednesday, and by Friday we had a deal. Just no one works that fast,
Mhm.
except for Corgi.
Now, okay, so that the deal took 2 days. We're trying to provide value for people that are listening here. What did how long did the SEC take? Did that still take 3-4 months?
That there's nothing anyone could do on that.
Yeah,
That
yeah.
one takes 75 days, I believe.
Okay.
It's called a quiet period. So you file to register with the SEC, and it takes about 75 days, for them to like approve it.
What do you wish you knew now? Uh, before when you started.
Wh- wh- what do I wish I knew then?
Yeah, yeah, yeah. Or yeah. To to
Oh,
rephrase that.
yeah, yeah. What do I wish I knew then? Well, geez. I think in the past, I knew I created something great, and I thought, well, if I could just tell the story, it's gonna all work out. And the truth is, no one cares about a great story. You have to be a thought leader yourself, and uh, then people care about your story. Even though you could have this great idea, no one's gonna care about it unless they care about you. So, um, I should have uh, known that earlier, and I'd be in a better place had I known that earlier. But I'm in a good place now. But um, I thought the story itself could carry it on its own, but no, I have to be a thought leader and carry that story. So that's one learning lesson.
Yeah.
Is that you can't just have a great story. You have to become a thought leader yourself.
Good.
Absolutely.
With what's next in store for Inside Ownership?
Well, we're going to be launching, I think in every market, every country needs an inside ownership weighted index. So, people in China may want to invest in leaders as well. I mean, like I mentioned, humans are power law, right? So every country will eventually have an inside ownership weighted index, and we'll be launching those. So we're working on Europe, Japan as first, eventually emerging markets as well. Those are a little bit tougher. The ownership structures are very intertwined in like India and China, a lot of like cross holdings and things like that. So, but the first step is launching a Europe and Japanese one.
Very exciting. Going global. Amazing.
Going global. Yeah.
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 Awesome.
And also, spending a lot of time on the current one that we have and getting exposure and getting people to replace their SPY or QQQ with OWN, right? The ticker symbol for
Yes.
this ETF.
Yeah. I love it.
OWN.
That's
The
great.
ticker. Awesome. Well,
OWN. Yeah.
Haren, I think this is a great spot to wrap up. Really appreciate you sharing your insights with us. Where could people go to connect with you and learn more about Inside Ownership?
Yeah, well, my website is insideownership.com. They could go to that website. I'm very findable on the internet. So, I would recommend going to that website. And if they want to contact me, I think my email's in there. I'm also on LinkedIn, very easy to find as well. So, yeah.
Awesome. Well, this has been great, Haren. We'll make sure to include all your contact info in the show notes as well.